Shares of Ford Motor Company are in high gear today after a third quarter earnings beat, but the Detroit automaker lowered its guidance. For more on this, we're going to bring in Tom Narayan, lead equity analyst covering global autos at RBC Capital Markets. Good to have you join us. Thanks for taking the time.
Sure.
So there seem to be some good and not so good news in these latest earnings. Why do you think investors are reacting so positively?
Yeah, I mean, the bad news why they cut the guidance has to do with a one-time event. It's the Novelis fire, which we all knew about. And actually, the volume of vehicles that is going to, lose production is actually not a hugely problematic volume number, and they'll get back a good chunk of the relief next year. So I think folks understood that, and the number that they came out with for that was already understood. The positive news was the tariff news. So tariffs came down by $1 billion, by effectively chopped in half this year. And we saw the same thing happen earlier in the week with General Motors. They cut their tariff as well. And what happened was last Friday, the U.S. administration changed a key policy, this 3.75% MSRP offset, which had to do with parts that qualify. They broaden the scope of those parts, and it turns out that it's actually quite substantial. And the same reaction, GM stock was up like 15% that day. Ford, you're seeing up like 10%, largely because the tariff amount got cut so substantially. What that means is next year, when you look at what the profits will be next year, now you can use a different tariff number that's a lot less than what people were thinking was before.
Interesting. Okay, we're going to talk about GM coming up, but just sticking with Ford for a moment, is that why you raised your price target on Ford?
Yeah, definitely. My numbers went up because the tariffs went down for sure. Now, we're still a sector performer on the name because another thing we noticed, it's a little bit concerning. Their EV losses got worse. We were hoping that it got better. So the worsening EV losses is concerning because while their total company's profits or EBIT is $6.25 billion, something like negative $5 billion within that is EV losses. So if that gets worse, you can see how that could eat at the total EBIT or profit number. We think what probably should happen, what happened with GM earlier in the week, is they should just do a large impairment or write off, maybe pivot completely or substantially towards ICE cars. Maybe it's a one-time hit. And if they did that, then I think the market would appreciate that, and we could get maybe a little more constructive.
Okay, let's talk about GM then now, because GM in the news quite a bit today, announcing it's cutting hundreds of jobs. Canada also reducing the tariff-free import quotas for GM by 24%. But you've also raised your target for GM as well. I mean, tell us what you like about GM and what they're doing right, apart from what you already mentioned when it comes to slashing the tariffs.
Yeah, I mean, the tariffs is a big thing. But beyond that, they did take a big write-off, $1.6 billion charge related to EVs, pivoting towards ICEs, retooling existing facilities, kind of ripping the Band-Aid now. I think that's the smart move. They're also just better positioned, I think, than Ford. They're not in Europe. They have like 60-70% dominant market share of large SUVs in the US. It's like the best business in autos in the world. Their China exposure is not problematic. It's just a really well-positioned business in the current environment. And I do have to bring up tariffs. One thing we haven't talked about is USMCA. That gets renegotiated mid next year. Could be a huge boon for these guys. Also, Korea is a big tariff that they have to pay. There's a deal on the table. It hasn't been formalized. There's more upside there. So there's a lot of reasons to like GM, and we think there's still more upside left to the stock.
When it comes to the free trade agreement being renegotiated or renewed next year, what would you like to see that would help out these companies?
Yeah, the big thing that people are talking about is putting in U.S. contenting rules. So what does that mean? Currently, you have to pay a 25% tariff if you produce in Mexico or Canada. Before the old USMCA, you just had to produce in either of these three countries and you didn't pay any tariff. So what if they put in a U.S. contenting rule? What does that mean? You have to make, let's say, 50% in the U.S., and now you don't have any tariff. I think most of the D3 is around 40%. So all they have to do is increase production in the U.S., a little bit, go from 40 to 50%. And all three of the D3 are already talking about doing that, already underway. That would be huge. Maybe the entire USMCA winds up being a zero tariff for the D3, would really advantage them versus, let's say, the Europeans, the Japanese, and the Koreans, for example.
Okay, that's all the time we have. Tom Narayan,
Sure.
lead equity analyst covering global autos at RBC Capital Markets. Thanks for joining us. Appreciate your insight on that.
Sure.